I've been very bullish gold forever. Now, I'm very worried what it's going to do, something similar to in 2008. Initially, remember 2007, it was up 30%. Fundamentals are great. It popped up 1,000 in 2008 in Q1, and then dropped to 700, dropped 30% as we entered the crisis of 2008. I think that's happening now.
Let me just on one point that I'm glad you brought up 2008. When that happened, when the price fell from 1,000 to 700 in gold and 21 to 9 in silver, what was very interesting in my market was that there wasn't an ounce of gold or silver to be found for the second half of the year anywhere. I thought we were going out of business, and I'm dead serious.
The current behavior of gold and silver has begun to mirror patterns seen during previous stress cycles, where rapid price surges are followed by sharp, paper-driven declines that fail to align with physical realities. Despite temporary retracements in the charts, the underlying conditions shaping this market are unprecedented. Global rate cuts, expanding fiscal deficits, rising distrust within banking systems, and growing signs of physical tightness across major mints and exchanges. These signals point toward a market where price volatility masks a more profound structural shift already underway. Mike McGlone, a longtime strategist focused on risk cycles and technical exhaustion, and Andy Schectman, a veteran in the physical bullion supply chain, have witnessed firsthand the strain appearing beneath the surface. Their combined view reflects a market transitioning from calm to turbulence, with gold behaving like an early warning system rather than a lagging indicator. What unfolded in 2008 serves as a reference point, not a blueprint. Back then, prices collapsed on paper while physical products vanished globally, revealing the limits of leveraged markets. Today's environment is marked by far more stress, backwardation in silver, depleted inventories, unprecedented central bank accumulation, and a global financial system struggling with trust at every level. The combination of monetary expansion, geopolitical fragmentation, and eroding confidence in U.S. fiscal management suggests that violent shortages and renewed demand pressure could follow any significant pullback. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I guess the only thing that really comes to mind to me when you talk about going back and looking what happened in 1980, at its previous peak, Volcker raised interest rates to 18.75%. That's not going to happen now. I don't know how many global rate cuts we've seen this year, 500 or more globally. The pattern is for lower rates, of course. At least that's what they want. And I think it's very different when you see countries like Poland, who started out with their target at 20% for national reserves, raised it to 25%, and now they're going to 30% national reserves. You look at the amount of gold that is being imported by the central banks. There was just an article that came out that said only 1 in 3 transactions is actually being reported. They're buying way more than they are telling. And so you look at the United States, we've become a net importer for the first time ever, and we're importing billions and billions and billions every single month. I think it is different this time because a system, the United States, which has flourished, you go back to 82, interest rates fell at a 45-degree angle ever since, making traditional assets what everybody wanted, and this country was revered and trusted. And you look whether the repo market right now, where the banks aren't trusting each other because there's double the liquidity in there than we had it in 2019, and yet the Fed just came in with 125 billion over 5 days. That's crisis level. You look at the backwardation in the silver market. They don't trust that they'll be able to roll their contract forward and get it in the following months, or they don't want to cash settle. They want the metal now. You look at de-dollarization. You look at all of this stuff, it's all based upon a lack of trust, whether it be globally with the de-dollarization and the treasury issue with sanctions and tariffs masquerading as sanctions. You look at all of this stuff, and I see an issue of trust and fiscal irresponsibility, where in 6 weeks that the government was closed, we added $500 billion in debt. The previous trillion happened in 71 days. A trillion seconds ago was 31,688 years ago. We're fiscally irresponsible. Nobody trusts us. The markets don't trust anyone. The banks don't trust anyone. This is a game that I think is about the United States has lost trust, and the markets have lost trust. And even the participants in the overnight repo market trading 24 hours next day not even just overnight. No, I don't trust you. So why did the Fed have to come in and put 125 billion in? I think it's different in the respect that you could argue if it were a chart that the US peaked on its way up to 2011 or 2020 and it started to come down. And that's kind of where we are now globally with the lack of trust. So to me, gold is trust. It's trust because it is not someone else's liability. It's an asset that has no counterparty liability if it's in your own possession. So I get it. I get why you would say that because history hasn't been kind to gold. But I would argue maybe history won't be kind to the US dollar the way that it once was, or the desire to hold our treasuries the way that it once was. So I guess that would just be my own pushback. I'm not the guy to talk to when it comes to charts. I follow everything you're saying and it makes great sense. But maybe, and I'd like your point on this, Mike, and all three of you guys are technical analysts. I would argue that the metals markets have been for a very long time manipulated by the Western central banks, period. Is technical analysis valid in a market that has and has a greater amount of central bank intervention? At what point does that painting the tape or does the reading of the charts maybe not work out the way one would think?
I think that's a great question, partly because it's a lesson I learned in the trading pits from a lot of very successful traders who did not care about the fundamentals. And most of them are either dead or retired, not all very wealthy. Is the discipline of what charts can help you do. Now, what you said about gold are known knowns. I appreciate them. You accelerated it. I got it very well. I've been very bullish gold forever, but at a certain point, I have to switch off my hat to from fundamental or technical analyst. I'm both. I'm whatever I think works, to a risk manager. And I look at it, if I'm running any money now and everybody in my desk is overweight gold, partly because the market made them overweight gold, this is a level I have to be very cautious. Now, I'm very worried what it's going to do, something similar to in 2008. Initially, remember 2007 was up 30%. Fundamentals are great. Popped up 1,000 in 2008 in Q1, and then dropped to 700, dropped 30% as we entered the crisis of 2008. I think that's happening now, and that's part of what gold just front runs things. But that's why I just put on my, I've shown that chart. I just put on my risk manager hat and says, basically, when you get this stretched in gold, and the fundamentals everybody gets, it's just we haven't had the pile on yet from stock market going down, is to have the discipline of knowing where and when to buy. Now, you've been long and bullish gold for quite a while. I have, and basically been way overweighted. And I look at, sometimes it's okay to say, take some profits and do a little selling when the market's yelling.
Let me just on one point that I'm glad you brought up 2008. When that happened, when the price fell from 1,000 to 700 in gold and 21 to 9 in silver, what was very interesting in my market was that there wasn't an ounce of gold or silver to be found for the second half of the year anywhere. I thought we were going out of business, and I'm dead serious. In 2008, the U.S. Mint shut down a half a dozen times. The Perth Mint in Australia ran out of product for the first time ever, took no new business after August. The Rand Mint in South Africa was cleaned out. One wealthy Swiss businessman flew a 747 there and cleaned them out for the first time ever. The Canadian Mint, the Australian Mint, and the Canadian Mint, the Austrian Mint, the UK Mint were working 24 hours a day, 3 shifts, 8 hours apiece, and they were as much as 12 or 14 weeks backordered across the board. And nobody, I mean nobody, sold anything. I am a authorized reseller of the U.S. Mint. They said, we will take no orders. We'll let you know when you can take it. And when they finally came back online, months and months later, into the fall, right around this time, they said, fine, we'll take your silver maple leaf order or your silver eagle order. With $9 silver, you're going to pay 18 or 19 bucks, and you're going to wait 8 to 12 weeks to get your product. You got to pay up front. And the same thing was true with gold. What I'm saying is it was a paper-derived smash-down drive-by shooting. And if you do that now with naked shorts when silver's in backwardation and the exchanges are being bled dry, that's exactly the environment that these traders across the globe are going to jump all over and say, fine, we'll stand for delivery. Where's the product? And that to me is an existential threat. And I wonder, is it true to you that the only way to manipulate a market is to push it in the direction that it is going? But when you throw in the delivery ability to stand for delivery, like we're seeing in silver and the chaos that's creating in both physical silver and in SLV, I don't know. I think it's something that these traders would need to think very, very cautiously about, because I can tell you in the physical world, there was not one person that sold anything and the price just cratered. So I don't know. It's nuanced for sure, but again, could it be different this time? Don't know. It feels it to me in my gut, but I defer to you guys. You have the career in technical analyzing these markets, and I respect that. But
Yeah,
I'll tell you,
Andy, I
that
would
was
say
a
that
weird time.
The current behavior of risk assets highlights a widening gap between public positioning and underlying market stress. Equity exposure, margin leverage, and option speculation have surged to record levels, even as volatility indicators sit at multi-year lows, creating an environment where minor disruptions can cascade quickly. Precious metals continue to signal a different story. Gold breaking through long-term ratios, silver preparing for structural rotation, and the gold to Bitcoin relationship breaking beneath decade-long supports. These shifts point toward a market recalibration that is only beginning to surface. At the same time, long-term volatility measures, index momentum, and multi-cycle moving averages across major benchmarks are aligning in a way historically seen before major reversals. Bond performance relative to equities is also setting up for a powerful reversion, hinting that liquidity tightening, global rate realignment, and unwinding of carry trades may soon force repositioning across every asset class. Now let's get back to the interview.
The public is really hasn't been a massive participant in the gold rally. It's been more along the lines of the central banks and whoever the heck is importing billions upon billions every month into COMEX, the sophisticated traders. Maybe it's some of the people listening to the chief investment officer of Morgan Stanley who said, sell half your bonds and put 20% into gold, or Michael Hartnett from Bank of America who said, no, make it 25%, or Jeffrey Gundlach who said, no, 25% is not overweight. Things I never, ever thought we would hear. I think the public is behind the curve. And if you look at the recent data, they're all in the stock market, highest ever, largest margin debt ever, largest option exposure ever. The public's in the market. The big money, the central banks, the commercial banks, the sovereign wealth funds, they're the ones that have been driving not only the gold accumulation, but the deliveries off of the exchanges. So I think the public is the last one to get involved, and really, other than some very large orders by people who are paying attention, I would say the public at large is not involved in this market hardly at all.
First of all, I'll start with my favorite ratio in the entire business is the ounces of gold for one Bitcoin. It's broken down through key support at 25. It's at 21 now. Our model says it should go to 13. I pointed this out for a while, but the bottom line, I stick with it going lower, is stock market volatility. 120-day volatility is still absolutely buried at the lowest since 2021. If we end the year here, meaning if we don't have more volatility, it'll be the lowest year end since 2017. That's unlikely. To me, it's just getting started. And I want to show you the same thing as we've never had a year with gold up this much and Bitcoin down this much. This is a Bitcoin down ratio without the S&P 500 down on the year. Now, we've only had 2 down years since Bitcoin was launched, since 2008. And this is still a red year. What if it goes red on the year? It would make sense. It's hopefully, and if it doesn't go this year red, we're probably going to get the 3rd down year in the S&P 500 since 2008. It's just a matter of time. That ratio is telling us. I also point out, here's one key thing that really concerns me, is this is the S&P 500 announces a goal. You can go back 100 years. It's breaking down through key support. It's broke through that low in 2020. This is a month end. We have to go back to the base was set up 10 years ago, 15 and 16. We're potentially going to break through that level. At the same time, I overlay this with Bitcoin versus gold. It's also breaking through key supports. And then I like to point out, here's the key leading, the tip of the iceberg, strategy. We all know what strategy's 200-day moving average rolled over. Bitcoin's 200-day moving average has rolled over. It's hard to see it here, but it has. What's next? S&P 500. It's logical, but here's another key reason. This is the VIX 200-day moving average. It's been in a bull flag pattern since May. It's just breaking out higher. It's just getting started. So I also like to point out another key thing is, again, here we have stock market volatility buried. This is 120-day volatility, but this is another way to look at gold divided by S&P 500. 200-day moving average is just starting to turn upward. And again, what's the same thing? We have the VIX absolutely, or actual volatility, absolutely buried versus the VIX. It's just a matter of time. It catches up and VIX goes higher. It's just a question of when. So I have two more I want to show you. And this is one thing I'm concerned about gold and definitely want to know your view on this, Andy, is here's just a gold chart going back to 1971 when we came off the gold standard. And I like to take it simplistically, just to take gold versus its 60-month moving average. It's exceeded the high from 2008 a little while ago, and that was only a 1/3 correction. And then exceeded the high from 2011, which was the peak that lasted for 10 years. You have to go back to the 70s. This is when it went from 300 to 800. I remember this. And then it went back to 300, and it stayed around that level for 20 years. It's not a place I want to be outright long gold. That's why I'm concerned about selling everything. And I'll end with one key chart that might be the next big trade. This is the total return of the TLT ETF divided by the total return of the S&P 500. See that hockey stick going straight down? I'm afraid it's going to do the hockey stick part now. It was hovering. This is just from a base of 100, 2001. It hovered around 100. The peak around 2020 was 100. Now it's at 22. It's so buried. All it takes is a little flip for that to pop up. The S&P 500 giving back some more gains this year, and I think we're going to see that hockey stick kick in. And yes, I've been wrong on this one for 2 years. It's a major memory lane for me because I started trading JGBs in 1995 at night in New York. My kids were young, and I remember that very well. Didn't have 30 years then. It was just a 10-year now. And I think that's significant. It's a reflation, but remember what the situation is. It took more than 30 years to get here. The 10-year note yield in Japan is still around 1.8%. The 30-year obviously going up. They don't have the depth of the market we have. It's not even a fraction. I mean, who would buy Japanese bonds and they were negative forever? It's also an indication, but the bottom line I like to say is, yeah, that's something. Just remember, that took decades to get there. And what got it in the first place for that reflation? The stock market and the equity and the housing market and real estate went way too high, and then it simply mean reverted, so they had to turn on the spigot forever. That's exactly what's happening in China right now. China's in the middle of that, and that's the next trade for the U.S., in my view. And to me, so that's why that's important. But right now, I'd watch that 10-year note yield or even 30-year note yield in China, and it's 1.8%. I think that's where the U.S. one is going, because Japan, it took 3 decades to get there. China's just getting started, and I think maybe we'll get to where they are after we get through the next iteration of massively pumping the system with liquidity, which China's doing more than Japan ever has, and it's next for us. But we did pump the system with liquidity most ever, and now we're getting towards that hangover. Cryptos are showing the hangover. Stock market's probably next, and I don't see what stops. I can show you one chart that solidifies my view on that, and that's the key thing I want to ask for Andy. You might view this as technical. What this is the 200-day moving average of VIX. This right here in 2007, that was the lowest ever. That got me really, really bearish the stock market. I held on for a while, but it turned out to be one of my best trades ever. I just held on to shorts and took forever. So the VIX gives you I don't look at it as technical, as an indicator of what's happened. This is what it's done this year. It's hovering right at this bull flag is right at the same low that was from 2011, the highs from 2006, the low. It's above these levels. It's a bull flag. This is telling me something. Get out of risk assets. And cryptos are the top of the risk assets. So I don't know if you consider this technical. I view this as an indicator that something is going to happen. And that's why I think part of why gold just figured it out early this year.
I look at what's going on with the carry trade. You got Japanese pension funds pulling out 1.1 trillion out of U.S. Treasuries now because keeping money in America loses them money after hedging costs. And when you have Japan stop buying, interest rates wouldn't just stay flat; they would arguably explode. And and I think that's the issue when you have 1.2 trillion in borrowed yen funding crypto, stocks, emerging markets. All this stuff has to unwind. And every hedge fund, every momentum trade, every leverage bet built on free Japanese money is getting margin called. I think it is a very important trade. And I don't know, December 18th is a big day for Japan. There's a 50% chance they hike again. So what happens then? I guess you could say the world's biggest piggy bank just got smashed a little bit. I don't know. It seems that way to me. It seems big, very big. And I would agree that it's probably bigger than people think.
Market behavior is moving into a phase where underlying stress is harder to hide, liquidity is thinning, volatility is positioned to break higher, and the most speculative corners of the financial system are starting to signal exhaustion. As traditional risk assets stretch further from their long-term averages, the defensive rotation into tangible stores of value is becoming more visible beneath the surface. Precious metals are responding early, reinforcing their role as the stabilizing anchor when confidence in policy direction wavers and leverage begins to unwind. Across global markets, the pressure building through rates, carry trades, and currency shifts suggests a shift in capital flows that will not remain quiet for long. These transitions tend to accelerate suddenly, rewarding those who position themselves before the crowd recognizes the change. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.